So good afternoon, everyone. It's always a pleasure and a privilege to be here to spend an hour discussing some of the issues in terms of natural resources, cost accounting, and the particular challenges that are arising in some jurisdictions that I have had the privilege of working in. In my background, I was trained as an engineer. So I studied chemical engineering back in Ghana, where I'm from originally. And then I studied economics at the master's level, and then I continued to do petroleum economics as well, focusing on tax and then investment-related issues. And then following on from then, I have been working in various capacities, but the last 2 years has been more intensive consulting roles, where you're involved, in either helping governments or helping private sector companies, better develop or fashion policies that would help them get or make the most use of the natural resources that they've got. So that's really a little bit of, my background. But today I just want to quickly dash into the presentation. And I may say that this presentation is off the back of a training that I delivered in Ghana about a month ago. This was to the Ghana Extractive Industries Transparency Initiative. So they have a multi-stakeholder group of about 27 people who attended that particular session, and it was just to refresh their memories on the topics that we're going to discuss. So most of the examples that I may be using here would often come from a developing country sort of context, just to give it a bit more color and flavor. But the issues generally are very much, global in scope and then in shape. So I'm hoping that, by the time we're done with this seminar, we would be able to at least get some kind of basics in terms of, the concept as they relate to natural resource accounting, and then, look at some of the economic tools and methodologies that are used to do or evaluate natural resource projects. And the third one would really be looking at, okay, when you take bulk minerals and you look at gold as well, how would you, or what factors would you consider when you're designing often it to be a concession, so a variable royalty mineral regime for such minerals? The last one came in quite strongly in the last capacity building exercise I undertook in Ghana. So in fact, we spent probably, if not half of the day, discussing some of the issues, around designing a good royalty regime for bulk minerals. So I just hope that we can at least get some of these concepts, and some of these tools by the time we're done in this session. I've got about 50 or so minutes. We'll be taking Q&As, right? Yes. Okay, so I'll try and wrap it up in about 20 minutes, because I believe more in having an interactive discussion rather than, a lecture. But the materials hopefully would also be shared in the sense that there's quite an extensive, documentation pack that I prepared as part of this seminar. So if at any point or after the seminar you want to get some extra reading or want to get some of the concepts, then please feel free to reach out to the moderators. So with that done, I'll just move quickly into the things I want to focus on for the first part. Just quickly rush through the nature of risk as it pertains to mining and mineral projects. And then I'll delve into the cost and the cost-related issues, the accounting principles and standards. And one often overlooked aspect of all of this, auditing. So what role do regulators and institutions, national institutions, have and can play in terms of ensuring that if the companies that are extracting these resources say that I spent $100 buying a particular equipment, then indeed it's 100 and not 150. So we'll look at some of the cost recovery issues and how it relates to auditing as well. I guess quite a number of us would already know the extractives industry value chain and the processes in lieu of that, where you have to set your legal framework, get some data to do your seismic, and then use that to actually award the contract, and the right. And then once the contract is given, it's the issue of, monitoring the operations, collecting the taxes, and the royalties that are due to the state, and managing the revenues that come out of that. And eventually, it's got to drive developmental outcomes, and these, different components of the industry are mutually independent of each other. But for today, we're not going to talk through all of these, segments. I'll just focus particularly on, the collection of taxes and royalties, and then some of the issues around, contract, award and licenses. So just quickly rushing through, we need to find the resource to be able to tax. And to find the resource means then having to conduct exploration operations. And that is also, of course, dependent on doing geophysical or seismic surveys, regardless of whether it is oil and gas or it is mining. You need to collect some data, and based on the data, you'll be able to make some interpretations and decide then that this is where I'm going to sink my hole. And based on that, you may find some resources and then further progress them into reserves that one would produce. However, it's an expensive business, and it's an expensive business in the sense that you're looking at about between 10 to 20% probability of success, especially with oil and gas. So basically, for every 1 in 5 wells that you drill, it's only one of them that may result in a discovery. And the challenge then is, do you want the government to spend its money engaging in this very expensive venture for which there's almost 80% chance of failure, or private sector individuals are better off, doing or undertaking that activity with the expectation that they'll get a commensurate return for, undertaking that. Generally, as we've seen, in a lot of the developing countries, the government just doesn't have the money. And so they would award these rights to private companies to explore for the resource. And then, we'll have a tax regime around that, which will collect those royalties and taxes and use that for the development of the country. The extractive industry generally has issues that are very distinctive or peculiar to the industry. So, for example, I just mentioned a few moments ago that there are various technical, fiscal, commercial issues in terms of the probability of success. You need to spend a lot of money to discover these resources. And sometimes when they even discovered, between the discovery and the production, you're looking at 5 years, 6 years, even 7 years. I know of fields that have been discovered here in the UK, in the North Sea, since the 1970s, and it is only recently that they've been brought on stream, because at the time the technology wasn't as good enough to extract them on a commercial basis. And then you're looking at very long production periods as well. Just want to touch most recently, contemporary issues with managing the environment, climate change, and to the extent that some of the European banks that in the past would have been financing a lot of these, fossil-based resource-driven activities are starting to even think about pulling out from some of these, investments. And the resource itself is, non-exhaustible. So when you take it out of the ground, it's pretty much, gone. Of course, it would have been formed over millions of years. So potentially, if we're still alive, then in a couple of million years, maybe, but we will not be alive then. Perhaps our children and our children's children, which brings into question the issue of intergenerational, equity and extracting the resource in a way that brings a win-win for the current generation and then, the future generation as well. So for governments, often, because they don't necessarily have the capital to extract these resources, then it means they would often have a tall list of things that they're demanding. So you've got the government on one side, you've got the private investors on the other side, and what the government often would want would be to maximize the revenues that accrue from the resource. They want local content, they want, reduce the environmental footprint, but they also want technology access and transfer. So for example, when I was recently in Ghana as part of another project, you can see that the government is very much actively pushing the local content and local participating agenda, sometimes to the dismay of the IOCs, because what the IOC actually wants, or one of the things that they want to do, is actually the freedom to make their investment decisions purely on commercial considerations without, or with limited interference from the government. And there are companies that have applied for oil blocks awaiting or have submitted their plan of development and have signed the petroleum agreement, subsequently made a discovery and then submitted a plan of development, but these have still not been approved by the government because the government wants to, cement or get more in terms of the local content and local participation. So, what you can see clearly is that often the government's objectives, what they want, and then what the investor wants are not necessarily aligned. And so from day one, you could say, well, maybe that's a recipe for conflict, not disaster, but, a conflict. So how do you align these incentives in a way that it creates a win-win for everyone? The alignment of the incentives ultimately in economic terms has got to be targeted at the economic rent that would be generated from the resource. In very simple terms, it's just that is the price that you are getting over and above, right, the cost of extracting that resource. So that is more like profits that have been, or supernormal profits that have been generated. And in theory, at least, economic theory will tell you that then you can target, those rents with whatever range of taxes. Of course, the reality is that you would have a mixture of issues. So it may not be targeted purely, 100% on the economic rent, and we'll get into some of the issues. So there's a very interesting quote from the IMF. This is back in 2011, that it's the prospect of getting substantial returns in excess of the minimum required by the investor from the underlying, resource. So I did mention the potential misalignment of interest between the state and then between the private sector individuals. And what this really does show on this chart here is that as the maturity of the basin expands or moves forward, then you would actually see that the bargaining power between the IOCs and then the government begins to also shift. That often when it is developing or becomes, mature, then the government will say, oh, but we signed a bad contract, so we want, to renegotiate the terms. And then the companies feel like, well, a contract is a contract. You've got to honor those obligations that are in the contract. And one of the things that often comes in this, or why there are often this conflict between the state and then the private sector developers who are bringing the resource out of the ground, often has to do with cost and how you classify cost and allocate the cost. Because once you get the resource out of the ground and you're able to sell, whether it is oil or it is gold or any other natural resource, you have to necessarily deduct the cost of that extraction out, and what is left is what you then share between the state and then the investors. But it means then the ability of the state to collect more in terms of taxes from these resources is dependent on how well they're able to control or have control over the cost that the companies are posting. And so I just want to now delve more into the cost issues that come up, how you classify which cost, and out of that, how you actually even go about doing your auditing. Just some quick points here is that from the very go, when the petroleum agreement is being negotiated, and then also subsequently when production starts, it is important that we have a very clear basis, and clear definitions on what the various categories of the cost are. I have seen some petroleum agreements that often, when it comes to these things, it's a bit of a gray area. And the more gray it becomes, the more difficult it is to interpretation. You could argue, of course, that gives the lawyers more work as well, but you don't necessarily want to create that. And then I've also seen other petroleum agreements where if you look at the appendix to the petroleum agreement, there'll be like an accounting guide. And then within that accounting guide, they go into nitty-gritty detail as to what constitutes which cost and what is allowable and what is not allowable as a deductible expense. And which also then means that we have to be very clear on which categories of these costs they fall within. So for example, your exploration cost, or the four broad categories, and we'll look at the subcategories. Your exploration cost, the appraisal cost, the development cost, your operations cost or the OPEX, and then your decommissioning or abandonment cost as well. In a lot of the developing countries, you would often see that when it comes to abandonment, particularly, there is a decommissioning fund that will be proposed, and that will say that at a point when you produce a certain amount of the reserves, then you have to put some of the money into a fund for potential decommissioning. In the more Western jurisdictions, the liability for the decommissioning actually is on the company that is exploiting the resource. And in the UK, this has been a big issue in the UKCS and in the Greater North Sea, where for some of the companies, they've extracted all the oil and gas out, and they're facing this huge liability of decommissioning. The UK estimate for decommissioning is around, the latest one I checked, around 50 or 55 billion pounds of potential decommissioning cost that the oil companies, have to find money for to return the seabed and to its, natural state. So generally what you see, and these are just rough numbers here, is that if you begin to look at the cost on a unit basis, if you break it down between your exploration, your development capex, and then also the abandonment, then there's a ratio of about 1:1, or 50-50 generally. So what I've put here on that chart, which you could see, is that your capital cost for projects, and this is just a general guide, this would vary from region to region, But generally, you're looking at about 45%. And then your OPEX, which includes your G&A, your general administrative cost, and then your production and lifting costs could be another 50% potentially of the total cost of executing the project over its lifetime. And then other costs, service costs, special items, abandonment, potentially also another 5% or so thereabout. But this varies from region to region in terms of the amount that play. So I did mention that in the UKCS, there's a huge decommissioning liability that the oil companies have to fork out, and some of the companies may be having difficulties, in terms of even raising some of these monies for these decommissioning liability, or will try as much as possible to defer that, as far forward as they can, into the future. So for the state agencies and the state institutions, the ability to control cost, as I've said, directly impacts how much revenues they can actually collect, and therefore how much they could use those revenues, how they can use those revenues for the development projects that would take place in the country. So here what I've shown is really some sort of baseline that allows us to, if we're really going to go into cost optimization and having different agencies work together. So the experience that I've seen in a lot of the developing countries is that you would have the National Revenue Authority being responsible for collecting these petroleum-related taxes. However, they may not have the information required. So they would need, for example, production data. They would need, for example, some of the lifting data, and it may be sitting at the central bank, or it may be sitting with the regulator, which really means then that you need sometimes 3 or 4, if not more, different agencies to collaborate, just on the issue of trying to understand, the cost position or the cost that the companies are claiming as deductible expenses for the petroleum operation. So to carry out, this process in a more rational and in a more effective manner, then for the different agencies that are working together, then you would actually need to understand, for example, what are your cost drivers, right? So you need to do a bit of empirical work here to understand your drilling, your wells, your completions, the top sites, and then you need to be able to run, different multiple scenarios. But at the core of what I'm saying here is that you would need different agencies and institutions to collaborate and work together. Sometimes it doesn't always happen in reality. So I'm privy to one example where on a particular issue with what one oil company was claiming as cost for some equipment that they had imported, there was a big, furore between the customs agency and then the revenue agency, and then of course the regulator as well, to the extent that it took well over 1 year for that particular issue to be resolved, as well. And in the developing countries, you would have that different agencies are, actively involved in one way or the other to understand the totality of the picture in relation to cost. So having dealt with the issue of the cost, okay, we've got a bit of time. Dealt with the issue of the cost, I want to tie it into accounting, because the accounting methodology or the tool that you use directly impacts also the revenue. So for example, I'll explain whether or not you allow something to be expensed or to be depreciated would have an impact as to the timing of the revenues. So if I had £100 today and then I said, okay, you can take all of the £100 out of your 120 revenues, right, then it means that I only have 20 left. But if I had £100 and I said, okay, spread that 100 into 3 parts, so that's £33 each roughly, over, say, the next 3 days, then it means then that I can only take £33 from the 120 revenue, and therefore I have a much bigger base. You're going to be left probably with about 90 or so on which to, you know, slap your or impose those taxes on. So beyond even just understanding which costs are which, whether the exploration, you know, capital costs, within those ones as well, which ones are like, you know, tangible and which ones are intangible, which ones do you get 100% deduction of those costs against your revenues on, and which ones do you, you know, allow as depreciation expense. And that's all down to the accounting principle that the country would adopt. Broadly, there are two. I'm not going to go into all the details. There is what we would call the successful efforts, and then the full cost method. If you want to see the differences between the two, there's this very interesting table here that I've put up, where you can see that often most of it will be counted as, you know, capital cost. However, when it comes to things like, you know, your production cost and things like, you know, dry hole costs, then some of them are allowed to be, you know, expensed. I'll give you a good example with what happens in the UK. So in the UKCS, if you're a company and you spend, say, £100 again, or as capital cost on a project, then you're allowed 100% of that, you know, amount back. In Norway as well, the government even provides, you know, an uplift, and in other jurisdictions. So basically, it's like giving you an incentive to undertake your exploration and the capital development project, and you can, you know, get that money back plus that uplift, which is like an interest, you know, on it. It's just a way, one of the incentives that government would often throw in to encourage more exploration, you know, activity in some of these jurisdictions. The other thing to note in terms of the two different approaches is, where do you locate your cost center? Is it at the level of the country, in which case if you have 10 fields, then you can basically shift most of your cost around, or is it at the level of the field or the reservoir? So there are ring fencing rules in place that prevents you from moving costs from one particular field to the other in a way to reduce, you know, your tax liability. In most of these things, we just kind of have to be aware of. However, in a lot of the developing countries that I have been to and you know, been privy to work in, you would see that often they will have these ring fencing provisions around. So you cannot, or the IOC would not be allowed to move or shift certain costs from one field onto the other. There's an interesting case in Ghana where for the field, the Jubilee field, that they were in two different reservoirs originally discovered, two separate petroleum agreements, but they discovered again that the reservoirs were connected, and therefore they had to do a unitization of those reservoirs and renegotiate some of those terms. But for accounting purposes and for tax purposes, the two different companies that own these blocks, right, pay and calculate their taxes on the basis of the separate blocks. It's not actually collectively done, you know, together, because they are, although it may be the same company in block A and block B, they have different interests. And you may have another company in block A but not in block B, and then vice versa. So you would see that for accounting purposes, how you define where you locate your cost center becomes fundamentally important, you know, and it will also, you know, drive how much revenues the state could potentially, you know, accrue from those resources. How can we ensure effective cost recovery, or how can host government? So in this case here, we're looking at it more from the perspective of the host government. If you read most of the petroleum contract, again, they would talk about things like arm's length transaction or pricing. They also put in place certain clauses that would safeguard against potential cost inflation. And then what you also would see in a lot of these will be elements around third-party costs. So things like research and development. So because these IOCs are ordinarily very large companies and operate in multiple jurisdictions, they necessarily, even if they carry out research and development in, for example, say the UK, would have to charge the cost of that R&D to various cost centers. But you need some rules around what can be allowed and what cannot be allowed. So there's a very famous example that one of my professors gives about him doing some advisory work for the government of Nepal. And if you know where Nepal is, it's in the Himalayas. And this IOC came in and put a certain huge figure there as R&D cost. And he was brought in to, at that time he was advising the government as a consultant. So he decided to probe the R&D cost further. So what are these? What are the constituent parts? And then he was told, so this is me recounting what the person or this professor of mine said. He was told that, oh, but these are R&D costs for offshore operations, right? But Nepal is in the Himalayas, and it's an inland country, right? But by probing a bit further, what he discovered was that the amount being requested to be allowed as a deductible expense actually wasn't, the case. And there are so many often gray areas in some of these contracts that you would see that, the companies may want to, exploit. I don't begrudge them. They are in there to serve their, shareholders, although these days they use the word stakeholders. But, often the primary objective is the shareholders, and to deliver a return for the company. And then, some costs may or may not also be recoverable. So for things like your signature and production bonuses, may not be recoverable. I've seen some contract again where even things like arbitration costs, are allowed as a deductible expense. So say you and the IOC, or you were the state and the IOC got into a big fight, and you decided to go to or seek international arbitration. The costs of running that arbitration would eventually be allowed as a deductible expense. This is the case when you look at some contracts in Nigeria, in Ghana. I've seen contracts in Angola that have these things, but you see that it is often in a very tiny corner in the contract. You've got to look at the appendix and some of the annexes to the contract to see that things like legal costs, insurance costs, are allowed as deductible, expenses as well. So for the state agencies, because of the focus of this presentation was to some state agencies, involved in this sort of work, the emphasis and the case studies we did was really to highlight where some of these costs could be hidden and how that could be uncovered, and subsequently ask questions of the operator to provide a basis for what they are claiming they say should be allowed as an expense. So what often the oil codes will then provide to the regulators will be things like they have to provide production statements So here it could be daily, it could be monthly, it could be quarterly. They have to show how out of the volumes they got the value. So here we need to have the quantities and the prices that they realized during the period of those sales. And then they also need to even show the value of the stocks that they've got. So in my other career, when I was working for an EAP company, I was basically a hydrocarbon accountant. And my job, every morning was basically to collect some of this information, run the numbers, and then inform management about how much we got in production today. And then subsequently, you would, on a quarterly basis, also produce the same set of reports, and then on an annual basis, produce these reports. But that was what then we also had to file with the tax authorities, which then meant that we needed to keep a lot of the records up to date. But I can also tell you, even within that, you can see that there was still a bit of, some games code, going on with what the companies, can and cannot do. But these sort of statements are standard and will be required. Production statement, value statement. The companies need to show cost statement, expenditure receipts, the long-term forecast. And that then means that, again, the government actually has audit and inspection right. This also would be specified in the contract. So in all these contracts, you see that it will state very clearly that the contractor has to keep the books in good working order, etc. And then at any point, the government can actually call. So I've been involved in one particular exercise, for a state agency where they are auditing the operations of, one particular IOC or a group of IOCs in a block. And the issue was that the state says that the additional oil profits, or the supernormal profit tax had been triggered as far back as 2014. And the IOC also says, or the operator says, oh, hang on, this thing won't be triggered until like 2025, right? So there's a big disconnect, who is right and who is wrong. And we went in and took some data, and using some of the data that the IOCs, the company provided, some government data, did some bits of the modeling, and basically tried to help the state, determine what the true position is. But even with that, even after providing all the answers to the terms of reference, you often would see that it also then comes down to negotiation between the IOCs and then, the state agencies. So you may say, okay, well, you're owed $100 million, for example, but it could very well be that, they end up paying maybe 20 or 30, something like that. Okay, so that allows us to deal with some of the cost issues. And I quickly, because I'm conscious of the time, want to spend the next 3-4 minutes, and then we'll use 15 minutes for Q&A to look at, some of the economic evaluation methods or tools. The slide here is just really about, some principles in relation to non-fiscal aspects. So, we know the cost, we understand some of the costs, but how does that allow us to, or the state or the investor, to make a decision as to whether we proceed with project A or project B? We need some yardstick or some tools to allow us to do that. So quickly, what I've listed here is some of the tools that are available, that are often used in this industry. At the exploration stage, you may hear this being thrown about quite a lot, EMV, expected monetary value, which is just basically a probability calculation based on the success factors that you make a certain discovery of a certain type, and you have to spend a certain amount, to get that resource out. I'll show you in a moment. And then you also have, the more fancier empirical tools like the real options valuation approach. Often at the appraisal and development stage, you would hear the payback period cash exposure, NPV, IRR, profit over investment. The king, I would say, of all of these often is the NPV. That's what most companies, use. The OICOs generally are a bit conservative, as well. So in my other life, when I was working for an E&P company, you would run the economics, take it to your boss, and then, the first question would be, okay, what's the NPV, and then what is our, cash exposure, and how much are we getting on the pound, on the dollar? So that's your profit over your your NPV divided by your investment ratio. And we had benchmarks that says that, okay, for your P over I, profit over investment, it has to be, for example, over 30. So for example, for every dollar that you're investing, you need to get 30 cents back as that sort of profit. So these tools are very widely used across the board in the industry. This just shows you an example of the EMV calculation, where you've got different fields with different probabilities in here, and then you assign them, and then basically you work it from the back to the front. When you get the materials, you see an example in the and here the question was, do we decide to explore or not based on the chances of getting these or discovering these fields of that particular type. And going back to more fundamental corporate finance, the concept of the time value of money, which just says that or a proverb that says a bird in hand is worth or is better than two in the bush. So money in the present is worth more than money in the future. And when I come to you and tell you that I'll give you £1 today, I'm sure most of us will say we want the pound today than want it, even tomorrow or sometime, afterwards. But to compensate for that, it means then that because our future value has to be equivalent somewhat to the present, then you need to adjust it by some interest rate or factor. And so what that little mathematical formula there just shows you some of these factors. Likewise, you can see for MPV, and then I think I have in the subsequent slide for MPV over I, and then the real options valuation approach as well. Now let's look at the third point. I'll spend 3 minutes, and then we'll take questions on mining and bulk minerals. So I'll just use this example or this chart here to explain it, and then I'll stop and I'll take questions. So this is a work I did for one of the companies I'm involved with that looks or charts the trajectory of copper prices in Zambia versus the changes in the tax regime. And what you can actually see is that every time the copper price drops, then the government actually decides to actually tax the companies, more. Because at the point, the economy is entirely dependent on copper exports. So in Zambia, over 75% of, total exports is just from just one single commodity. The economy is not well diversified enough. So anytime prices, drop, then the government is running helter-skelter. Or sometimes when the prices go up, then they say, oh, but we give you a very flexible term, so the royalty rate is, maybe fixed. So we want to, collect more. Although they forget that, yes, the price or the royalty may be fixed, but you can collect more just by virtue of the fact that the increment in the price also means you're getting, more volume out of that. And so you see various things, these are except, news except, Zambia to raise mine royalty in 10th change in 16 years. So literally every 1.5 years, the government is, tinkering around the edges with the tax regime. What you don't want is this sort of thing. What you want is to design the regime in a way that is able to capture some of the, volatility in either the underlying price, or be also sensitive to like the cost, element as well. For bulk minerals, the big issue that came up at that discussion or that training in Ghana was, where do you assess the value of the bulk mineral? So the thing is mined. It will be, for example, weight. So the example we used was manganese, where they mine the resource. It leaves the exit of the gate of the mine. There's a weigh bridge that weighs it. But before it gets to the port and is eventually transferred onto, the big ships that will carry it to wherever, there may be some losses as well. So, okay, there may be some water, etc. in it. And the challenge in this case was, but we thought that they should actually be paying the tax based on the weigh bridge, volumes, rather than what is at the port. And there are big differentials in here with that. Yes, it may be, for example, 1% difference. However, if you're multiplying that by, X million tons of this volume, then you begin to see that, you're talking big figures, at stake here. To the extent that the government, in this particular case was Ghana, decided to close this mine for some time to allow an audit. And the audit was that they've been operating for so many years and they claim never to have made a profit. But these minerals were also being shipped out. And the other challenge was that for the bulk mineral, in the case of manganese, there's no known reference pricing. It's not like oil, that you actually have a couple of, basket prices for it. For things like manganese and some of the other bulk minerals, at that level, it's more kind of arm's length bilateral transaction trade. However, we also were able to show that, yes, that may be the case, but you could also be clever in terms of, if you know some of the trades happening in other jurisdictions and your quantity and the grade, then you could work out some indicative, pricing approaches as well. The really challenging issue for for the tax authorities in a lot of the developing countries is that they don't often have access to some of these databases and these data sources. So I ask them, okay, so where are you getting your oil price information from? And then they tell you, okay, well, we'll go and look at what's on BBC, or what's on some other place. But you need to subscribe to certain databases to get that information, or even some cost indices to see, okay, globally maybe costs are falling, but in a particular region, it could be that, not at the same pace, as others. So some of the taxes that are charged, I've just listed them here. For the royalty itself, there's different, types of royalties generally in the mining industry. Some which is based on the volumes, some which is based on weight, and then you have some which is actually based on a combination of both, and others that actually has a profit element as well. So the companies are allowed to deduct certain costs, from that before they even, calculate or pay the amount of royalty. But as I just shared and bringing this to our pause here in just 2 seconds, that the real challenge for a lot of the bulk minerals is like manganese, for example, that you may not necessarily have a universally quoted price for it. Gold is different because gold, we have, aluminum, there's some price for it. But when you talk of bauxite, then there's no price. Or alumina, you may get some, some indicative cost. But at the raw stage, with very little processing being done to it, it could be difficult at times to establish what the true cost, what the true value of that resource is, and therefore what cost do you allow against the value of that resource as well. There's a lot more in the slide pack and the materials which you'll get later, but I think it's good to pause now so we can have a bit more of an interactive section. Do we have questions? Yes, please.
Cost reports that are confirmed and maybe audited by the regulator, should it be accepted by the tax authority?
I'm not sure I understand you.
Say, for example, companies are required for production sharing contracts to submit their either quarterly or yearly cost reports.
Yes.
And mostly they may be confirmed by the regulator for the sharing of the oil
Profit, yeah.
Now, that same cost is the one submitted to the tax authority. Now, should the tax authority accept it as the regulator has accepted it, or should the tax authority go further to investigate? And will it have an effect on the company?
Yeah, so you're absolutely right with that, and thank you for the question. My position on this, based on what I've seen happen, is that often the tax authorities would have to go further, right? So a lot more work is required. But number two, you also would see that within the tax code, what may be allowable as cost for a particular item may not necessarily be reflective in what they've submitted to the regulator, because they're serving slightly different, purposes. Some regulators work very well with the tax authorities. Other times, too, they just don't work. And you may have to take the Minister of Finance to actually call them together. I've been involved in a project where we tried to set up a multi-agency revenue tax force, right, just for oil and gas and for other mining resources. And although the tax force was set up initially and they started doing a bit of work, after a while, the meetings weren't happening. But I think the obligation really, at the end of the day, lies on the tax authorities. Because the regulator, yes, may have some regulatory functions to perform, but they are not taxmen and they are not taxwomen. And the kind of questions that a taxman would ask or probe further, to get more clarity on, may not necessarily, come from the regulator or even the reports that the regulator would ask. So you would see some of these reports submitted to the regulator, but they're just high-level items. So we're spending £20 million to buy X, or to buy some pipes, for example. What's the breakdown of that? You may not get that, So I think, yes, it's more of the tax authorities going over and beyond it. Part of the reason is data and getting access to good data, good databases that they can check things like the pricing and the trading, information to calculate their own or what the taxes that are due to the states are. Okay. So please, yes, I think you had a question.
Yes.
Oh, somebody there? Okay. Christian. Okay, could you type it for us, if you don't mind? Because we can't hear you here. But whilst he's typing, we'll take another question from here.
Yeah, my name is Theophilus Acheampong. I'm an oil and gas economic student. First of all, thank you for the seminar, which is quite excellent for us. You can see it's a bit short of time for it. We require more time to understand all things. I've got two questions. The first one comes back to the same, like the one you were just trying to explain.
Yeah.
Just wanted to know, is there any international guidelines in regards to costs so that both sides, like companies and government, can focus on and just they won't like you explained the case of Himalaya, like it won't happen to either party.
Yeah.
So they can base on these kind of guidelines just for both of them to understand what to go forward to.
So there are one or two kind of initiatives, but there's no, as far as I'm aware, kind of globally defined benchmark. So also remember that the companies also, with their filings, they may be following like one particular accounting rule, right? So it may be IFRS, it may be US GAAP, it may be, you know, and that also further complicates, you know, the picture. There's been some initiatives, some being championed by the likes of NRGI and some other institutions to at least bring the regulators together, right? To maybe sit around the table and then share thoughts, opinions, and see if they can come up with some benchmarks. There's been some developments around things to do with thin capitalization and, you know, how much the companies can claim as like the interest expense on the loans that they went to are using for their project. But even with that, you can see that certain countries have nuances and certain jurisdictions have nuances, you know, around that. So I don't think we've gotten to the level yet where you can see, okay, this is the sort of benchmark, you know. But even if there were one benchmark, the question is, would it be legally enforceable? That's another question, you know. So the answer to that is that more work is needed, especially closer collaboration between regulators from different jurisdictions.
My second one, if I may. Sorry.
Yes, please go on.
My second question would be in regards to contracts. Basically before exploration and like obviously, because the case, the reason why I'm asking this is the case we've got in Senegal recently.
Yes, the big one.
Well, obviously everyone knows about it. Because what happened is that people think that the government just hand out contract quite early before like try and find out doing any researches and things like that. Because obviously like when companies find out there's a country that got oil and natural resources, they all jump like first to come, first to serve. Is there any kind of like a time frame after handing out their proposition for the host government to in order to get like the best of the company?
Yeah.
So in order for the government like the best to get the best of the contract.
Yeah, I mean, I think personally, from my experience, sometimes we, especially in developing countries, we rush too much to give these resources or these contracts out. You know, the oil is not going to run and go anywhere, and neither is the gold as well. But this is my personal sort of, you know, that you have to. And there's a saying in my local language that you use money to fish for money, right? So when you're going to go fishing, you need a small fish to catch a bigger fish. What I'm trying to say is that the government would have to spend some money, get good data, get good seismic, and that enhances their, you know, bargaining position when it comes to, you know. But often the challenge is that it may not really be there. And so the companies will come and say, okay, well, we'll do the exploration, collect the seismic, but then it means then you have to necessarily, you know, give away certain concessions that, you know, ordinarily, if you had access to better data information, you wouldn't have. Second quick point to that is that the oil costs or the private companies would always have more information than the government. So that asymmetry, as I mentioned earlier, in terms of the distinctive features of the industry, has and I believe may always be there. The challenge is how do you bridge that gap? So in the more established jurisdictions, the gap is, if not a bit more narrow than what you see in developing countries. But we have to put our monies, you know, where our mouth, you know, really is. So basically what I'm saying is that the government will have to spend some money to get good data before they even move to sign off some of these, you know, concessions. Okay, I think, yes, there's a question from Pooja as well, saying, you clearly mentioned it's important that host states should have various reports from the IOCs to be able to control cost. This, however, would mean great transparency and accountability, yes, which I believe, but how can that be ensured in the law, in the contract. So it's actually a mixture of both. I'll give you again an example from Ghana, and then maybe most recently with some of the contracts that have been signed in Tanzania and Mozambique. So in the Ghana example, what you would see is that in both the EMP law, the underlying law, and then also in the petroleum agreement itself, some of these transparency provisions and the statements that the IOCs have to provide to the regulators are specified to the minutest level of detail. So you look, there'll be an annex, and there's often an annex to the contract, which is the accounting guide. And then it will tell you, okay, these are the things that constitute your operational cost. I would send an example of those contracts as part of the materials that, that will be shared with particular references to that, at least maybe 3 or 4 contracts, you know. But you have that in the law, you have that in the PA, and then the question is, are the regulators, you know, positioned to actually enforce those provisions in the PAs? So a classic example is something that happened where the regulator was demanding a very detailed, high-level breakdown of the cost. However, the IOC also sent high-level bullets, right, of that and said, okay, well, this is 100 million, and this is like, you know, 200 million. And I was like, okay, go down, show us the constituent, you know, or component part. It had to take the threat of legal action to actually force the IOC to now come down and provide those, you know, a minute level of those costs. And also because they had imported a particular equipment into the country, and the value that was being stated on that equipment was far different from what you actually would get if you were bringing in, you know, buying it in, like, say in the UK, for example. You know, so sometimes there's a bit of a hanky-panky game going on between the regulators and then the oil coast. But I think the part of the solution to that is making sure that within the petroleum agreements itself, because that's what's the legally enforceable between the IOC and then the state, and the annexes in those agreements, you try as much as possible to specify, you know, the element of what constitutes which cost, and what things like your think capitalization rules, R&D costs, for example, in some of the contracts that I've seen, you know, in these developing countries. Now they'll put a cap, you know, as to how much you can charge for R&D, you know, as a percentage of either the OPEX or some, you know, other cost item. At least it means then you have a ceiling, you know, and therefore you can have some controls. In the past, that wasn't, you know, the case. So I hope I have been able to provide some answer to that to you, Pooja. But I would give references to those contracts as part of the document pack, you know, that you can you know, use for further research work. And I think Christian asked a question. So in your experience dealing with other countries, would you advise that royalties be fixed percentage, or should it vary according to the increase in volumes or in the price of the bulk mineral? The other thing you want for a lot of tax administration is kind of like simplicity, right? And of course, neutrality, stability, and all of those things. But the key thing is that the revenue authority should be in a position to actually administer the tax regime or the tax code with, you know, as much efficiency as possible without further complicating, you know, the issues. So in the Zambia example, I think I would have put it in as part of the backup slides. Just a second, I could use that maybe to explain if it's there. So in the Zambia example, what they did was to move from just a single royalty in the latest tax change to actually deploy a sliding scale royalty. That said that if copper prices are below $4,500 a metric ton, then they charge 4% royalty. If it is between 4,500 and I think 5,500, it goes up to 5%, all the way to When it's above 7,500, then you get 10%, of that. And then there's a fixed royalty for other mineral concentrates. So what you could see in this latest Zambia example is a mixture of both. So for the raw copper itself, they move from just a single royalty now to have a sliding scale royalty scheme based on the price of copper as posted on the LME, on the London Metal Exchange. So there's a norm, or there's a reference you could use to calculate that. But for some other mining or mineral concentrates, because these are not necessarily, you don't have a fixed price or a particular benchmark price for it, they just fix that one at a flat value. So what I would say to that really is that if it's the actual product, in our case here, maybe oil, maybe copper, or maybe gold, then you could actually do or use the kind of the sliding scale royalty regime. But of course, you can expect that the oil companies or the mining companies will kick back against that. What that allows you is not to then go back and change the regime every now and then, because as copper or the prices change, it will automatically pick up those variations or volatility in the prices. But for the concentrates and for some of the mid-grade mineral element that may not have that normal reference prices attached to it, the experience I've seen, generally is that they just put a single, royalty regime or royalty tax on that. So it could be a mixture depending on the particular circumstances that we're looking at. I think there was maybe 2 more questions or 3.
Okay.
Please.
Yeah, thank you. My name is Loyola, and I'm an LLM student. So I want to know from your experience and from an accounting perspective, what's your opinion on dispute resolution of disputes coming from costs accounting and costs accounting taxation issues? So I'm from Uganda, and we've had major taxation disputes
with Talo?
Pardon?
The Talo one?
Precisely, yes. Talo and historically heritage
Yes.
and others to Talo.
And yeah.
To get to the point of actually stalling.
Yeah, projects, yes.
So obviously the tax code and the contract itself and the PSS will have certain dispute resolution regimes.
Yeah.
Most times leading to international arbitration, which makes sense. I understand that logic from a legal perspective, but from an accounting perspective, what do you think, ideally makes more sense as far as dispute resolution is concerned? What's faster? Because you spend 2-3 years in arbitration. Yeah. Nobody wants that. Not the companies, not government. So
I can understand you. I mean, but there's some governments that, if you're entirely dependent, sorry. Okay. No, we've dealt with it too. Okay. So sorry. She was asking. This is one of our LLM students, and she's asking a question in relation to how these dispute resolutions, etc., impact on the project economics. For just to capture that, and that neither the government nor the IOC would want to unnecessarily delay, these disputes, I think fundamentally it comes from this misalignment of interest, from the get-go. So there's times where somebody will sign a contract and then the opposition party will say, look, if we get a chance to come into power, we would renegotiate or change the terms of these contracts. Or it could be the same administration and then they're like, oh, we've been caught, shortchanged or screwed, in quote. There are no hard and fast, rules on this. So whereas some of the companies may want a quick and early resolution of the matter, others too are prepared to play maybe the long game, because they have a bigger portfolio of projects. And for all that I care, although it may be important to Uganda, it's not necessarily, it's a small component of my kind of like portfolio. So I'm prepared to negotiate with the government and drag it on as long as, I can. And in any case, the contract says or may say that the cost of that arbitration could be recovered, right, as accounted as petroleum cost. Anyway, so the incentive is more like, in my favor as the IOC to do that. But I also have seen some governments try to resolve matters as fast as they can. And the way they often will do this will be through the JMC, the Joint Management Committee, which has a representation from like the national oil company and then the different, private investors. And at the JMC, most of the decisions will be put to a vote. So if the assumption is that the NOC is representing the interest of the state, so to say, then, they will be able to perhaps have some opinion and use that to lobby for the or canvas for the position they are. It may not always work. So there are instances where the NOC is doing something entirely different from what the Ministry of Finance, for example, would also want. I think with arbitration, the interesting thing is that we often see more of it happening when the oil prices begins to go up. There's a chart that I've seen produced by Stephen Dow, one of the lecturers here, which says between 2001 and between 1990 and 2003 thereabout, and 2007 thereabout, the cases with arbitration, you see on the chart, begins to rise as the oil price also goes up, because then. And this is often triggered by the government, because they say, wow, we're being cheated. We're not getting what is due us, etc. So I think the long or the short answer to this rather, long prose that I've made is that the country context and the factors will determine how far and how fast the issues can be resolved, whether at the cost level or even with other things like capital gains taxation. In the case of Uganda, the government says they have to pay us like $800 million. Yes, thereabouts, and then they're like, hell no, we're not going to do that. Yeah. I think you had a question as well.
Yeah. So you were just mentioning national companies, NOCs. And of course you have national mining companies
yes.
as well. So assuming that a country has enough money to just do the whole thing itself, then what would be the cost benefit of that as opposed to getting companies?
For example, Saudi Aramco, going the long haul and doing that by itself. It's an interesting question. But the thing at the back of my mind is, would we want the national mining or the national company to be doing all of that? And number two, do they have access to the technology, right, to allow them to exploit that resource in an optimal way and an optimal manner, right? Or are you better off bringing in some sort of partner, maybe in a minority capacity? Because what drives the sentiment is that you want to control the resource, right? And you want to control the pace of the extraction of the resource, and therefore you're better off if it's in your own hands, so to say. What I've seen is that most of these national mining companies and oil companies don't have all the money. So they could have 1,000,001 projects, very interesting ones, but they don't have the money or the technology to extract these reserves or resources. Buy a few ones in the Middle East, that, perhaps could go solo and do it, on their own. But I believe that even if they were doing that, then you would have this risk sharing type, contract that says, okay, we still retain ownership of the resource, etc., but you can come in and then help us do this, and then we pay you for it, right? So we retain the right to the resource both at the top side and then at the subsurface, you know, as well. And there's an interesting project going on, which I would entreat us to maybe check out, you know, as part of our homework, where there's a benchmarking study or some work being done by NRGI on the performance of state oil or national oil companies and national mining companies, and some of them as wasteful, you know, as you can imagine. So if they have the money and they were to even execute these projects, sometimes the cost overruns on some of those projects. Perhaps they'll be better off bringing a third-party partner, you know, in it, in whatever capacity to help them do that. But I would entreat us to check out that work. This is being done by NRGI. They've got a database or a portal they just put up a few weeks ago where you can see the performance of various national oil companies across a range of, you know, metrics. And yeah, there are good ones, there are average ones, and then there are bad ones, you know, as well.
And I have one more question.
Okay. Yes. Have we got any more questions from the people? If you have, please type. But I'll take one more here.
Given that exploration activities are high risk,
Mm-hmm.
to what extent should fiscal regimes be attractive to accommodate exploration in developing countries?
Okay. So you're saying, or she's saying that given that exploration is a high risk activity, how can the fiscal regime incorporate some of the risk in exploration to, yes, you know, to make it more attractive to investors? I think for the fiscal regime, as I was mentioning, I did mention briefly earlier, there are a number of things you want to look at, right? So you want it to be stable. You want it to not necessarily disincentivize, you know, the investors. You want some form of neutrality as well. And most importantly, you want an element of progressivity in it, which says that as the value of the project or the resource, you know, increases, both sides will share, you know, win-win. And likewise, if, you know, you see the value also declining, then the government, most times they don't, but also participating equally in that sort of marriage. So what that means is that your elements in the regime, so i.e. your royalties, your bonuses, your windfall tax, your corporate income tax, these all come together to make the fiscal regime. What I have seen some states do really is, even before the exploration even starts, right? They're already beginning to count how much money they will get from these contracts. And then they would also be thinking about putting a very high royalty, you know, on the resource, perhaps even before, again, any work is being undertaken. The point is that the private individuals or the private companies are often the ones doing these exploration activities anyway. So if the government were prepared to spend some money on the data side and get some good quality data information, then it strengthens their hand at the negotiation to now say, okay, well, I know the value of the underlying resource, so at least I have a fairly good estimate of what I've got. And then subsequently, I would then be in a position to negotiate perhaps, you know, better royalty rates, or accommodate or design the windfall profit tax in a way that when the company is able to make their supernormal profit or break even at whatever rate that is being offered them, you can still collect the extra amounts that are on it. It's a lot of work between that the state has to, you know, undertake. But sometimes I feel, I don't know if it's laziness, I don't know if we're, you know, but you will see that these contracts will be signed, and then often we'll come back and say, oh, but they've signed very, you know, bad contracts. Now, the quick point to add on a footnote to that is you again realize that with the very early contracts that will be signed, the terms often tend to be very generous, right? And then subsequently a discovery is made and that changes the whole game. So a good example, Guyana, what's happening in Guyana now, where if you scan through the media, people are saying, oh, but they've given, Exxon these very generous terms. It's only 2% royalty and 75% cost recovery, and even some costs that were incurred in 1999 have found their way in the revised 2015 contract, to be allowed as cost, oil before you deduct those, things out. But then you look at the statement coming from the state authorities now, and they're saying, okay, going forward now, any new contract that will be signed, we're hoping, our expectation is that we'll renegotiate better terms. Because now we know what is available. Now the basin has been de-risked. And you look for the 15 or 16 wells that Exxon, for example, has drilled in Guyana, 13 of them have found oil. And other companies have also announced similar discoveries. So that strengthens the hand of the state to now say that for future contracts, then you want to, but they will then also tell you that, oh, well, we cannot go back to change the old terms because you will get quite a big pushback from the IOCs and from some of their international partners, as well.
Related to progressivity you mentioned, if you read most of the international documents on progressivity, it's like royalty is what is expected to be more progressive to some extent, that most countries, especially developing countries, allow early royalty, which has an impact on the company's cash flow. And as a result, it is more preferable if royalty is based on a kind of profit, like instead of production or sale value.
So when you say profit, what do you mean?
You meant when you were talking royalty,
Yes.
you had different types. The ad
For,
valorem,
yeah.
and then you had a profit-based royalty.
Yes.
Now, the profit-based royalty is being seen as more progressive compared to the ad valorem,
Yes.
which is seen as regressive.
Yes. Okay.
So, if ad valorem is seen as regressive compared to profit-based, to what extent would developing countries?
So the challenge is for a lot of the developing countries, for the profit-based one, you have to be able to control the cost element, right?
And you don't have the data.
Yeah, so it may be progressive, all right, when you do the modeling, but if I can't control the cost, then I get nothing at all out of it, or could get some minimal amount. So it's a balance, it's a trade-off. So the government or most of the states will say, okay, well, you have other profit elements in there, like your corporate income tax or your windfall tax, which is also maybe profit dependent. But for the royalty in most jurisdictions, it's, it's just ad valorem, and it allows the state to get or share in some, of the early revenues that are accrued from the project. Most of the companies don't necessarily disagree with that. The challenge would be the rate, right? So again, my experience is, okay, if you say, okay, 3 to 5%, something like that, fair enough. But the moment you're talking 10%, 12% royalty, that has a big impact, on the project economics, because I have to give you all of this from the get-go before I even, deduct, some of my cost element out of it. So yeah, again, it's a trade-off. But from the developing country perspective and what I've seen, and sometimes even advice, yes, it may be one thing in theory, book-wise, that says, okay, let the royalties be profit-based, right? But you can only do that if you can control the cost and you know what some of the costs, are. If you don't have that sort of control, right, then it becomes a bit difficult. So you would need some form of ad valorem type, royalty. In the case of Ghana, somebody just showed me the tax code the other time that says even the royalty, although it is ad valorem based, it's also now, it's been allowed as, a deduction for corporate income tax. So in one sense, it's been taken and also been deducted some way, from the other, yeah. So the jurisdiction and the state of the regulator, or the tax authorities to be able to have all the information to make the calculations and be confident in those estimates should, or I would think, would determine what, method they would adopt, especially for this, royalty thing. But yes, in theory, a profit-based royalty would be more progressive than an ad valorem, royalty, yeah. Oh, okay, there was one last question I see from David. I wanted to find out if mention was made of Nigeria increasing royalty. I didn't mention Nigeria, but I did mention other countries, and I used Zambia as the example with copper, so very similar issues. Nigeria has 80% or 85% of it, again, it's exports coming from just this one single, commodity. And to the extent that it reflects the lack of diversification, in the wider economy, then often you will see the state or the government, tinkering around the edges of, these regimes just to collect, a little bit more. But if it's been fully thought through and the different elements that make up the totality of the fiscal regime have been, modeled and allows you to make some conclusions out of that, then we wouldn't be chasing these, changing these royalties, every now and then. What that shows me, what that indicates to me, is a government that is not prepared, or a state rather, that has not diversified the economic base enough to deal with these volatile commodity driven exports. And as someone just said, just quickly to round up, is that with natural resources, sometimes it makes the politicians lazy, or it makes the political class lazy, in the sense that you don't have to think hard about implementing your tax policies, tax reform, grow other sector, because whatever you do, you still get some revenues coming from the oil, or the mining or the gold anyway. And so generally what it then does is continually you see an erosion, of the institutional quality or capability in those, in those countries. And if you look again at the literature, and most of the literature around the resource curse, and the Dutch disease, etc., you see that institutions play like a vital role in whether or not, the country would escape that, or be caught perennially in that cycle. But I think that would be a good note to pause on. I'm hoping to maybe come back to do another one, which will be a continuation of this, but go into a bit more in terms of the actual fiscal regime, and we'll discuss some of the component parts, with some maybe worked examples. But this was just a bit of an introduction, but also just highlighting some of the capacity building that have been undertaken in a number of countries, over the years. And these are live issues that the regulatory institutions and then the national tax authorities are battling with on a day-to-day basis. Thank you.